Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on out there? It's July 3rd, 2024. I'm Frank Curzio, it's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. Hope all of you had a great New Year, holiday, spend time with the family, have some fun, because now it's back to work. And it's going to get pretty crazy. You get the Consumer Electronics Show, which I'm going to next week in Vegas. That's where all the largest technology companies, small technology companies globally, probably about 3,000 companies are going to be there, unveil their new products for 2024. You got the JP Morgan Healthcare Conference, a lot of biotech stuff going on and announcements. So the first couple of weeks going to be crazy. Lots of conferences going on. Lots of ideas. But overall, again, hopefully you guys had a great New Year. Watched some college football. Congratulations to Michigan fans. Wow, what a game against Alabama. Interesting. I went to the Gator Bowl. Quick story. And my neighbor his company's a sponsor of the Gator Bowl. And it was Clemson against Kentucky. And I was sitting next to someone who I just met. And his kids go to Florida State. And he was telling me, he said, just pound Georgia. Put everything you can on Georgia, because he said that 20 people, I think it was the day before the game. So this is the day before. I think it was, he told me that 20 people, at least 20 people who are on that team, scholarships, were not playing. And I think there was only, like the news only reported like a few people. And it turned out to be something like 30. So basically, they quit the game. They didn't want to go into that game. And it makes sense, because why get hurt, especially if you go in the NFL, but everything going on Florida State not making a championship, or college football playoff, having, Power 5 conference and stuff, and having an undefeated season. But sure enough, Georgia, I think, they win like 66-3 or something like that. But it's just incredible. They got to do something with the bowls and the transfer portal. How do they have the transfer portal open before the season's over? I have no idea. I mean, holy cow. It makes every bowl useless, because no one's really going to play. Anyway, congratulations to Michigan and Washington. Should be a really good game. But let's talk about the markets here, because it's an interesting start to 2024, where the Nasdaq declined 1.6 yesterday. So it's the largest decline to start a year since 2016, and it's trading down again today as I'm taping this. The S&P 500 also fell yesterday, which should come as a massive surprise, because I thought stocks go up every single week. That's what they've been doing lately. Every single week. It's not every single week. Let's put it in perspective. It's 9 straight weeks. We saw positive gains heading into the new year. So putting that in perspective, we rarely see that. Okay, since 1926, the S&P 500, or the S&P index, was created, there's only been 13 times, 1926, almost in a century. There's only 13 times that the S&P saw 9 straight weeks of gains. And the last time this happened was the end of 2003 into like the first week, I think, in 2004. A long time ago. So when I look at what happened, I wanted to go back and look at some stats to see, what happened last time. We had 9 straight weeks going in, and what happens to the market afterwards. And it's kind of like the same period, right, into, almost just a week off from 2004 to today. So the S&P 500 finished higher that year, 9% in 2004, which, again, it's 2003. It was like, the months leading in, month and a half, and then I think it was a week or two into 2004, which was a 9-week consecutive streak. But back then, when you look at the markets, S&P 500 is trading at a 22 PE, not forward, just a 22 PE. Today, we are at 26 times. Now, what does it mean forward? Forward is based on what your earnings are going to be in the estimates over the next 12 months, which is forecasted. This is just what the earnings were the past 12 months, right? That's a fixed number. The forward is a guesstimate based on the estimates that a company gives out. The analysts are going to estimate what the company's going to earn for the year. So these are not forward. So the difference between 22 and 26, that's not really a big deal. It actually is. It's an 18% difference. So you could say the market was 18% more expensive compared to 2004. But back then, so at the beginning of 2004, you look at GDP grew to 3.8% in 2004. And GDP is expected to grow, and I looked at the average forecast, I think it's 1.4%. And look at the conference boards, usually pretty good. They're expecting sub 1% GDP growth for 2024. Sounds crazy since last quarter, what was it, 5%? Big difference. Unemployment rate was close to 6% to end 2003. Remember, back then, the market still hung over the dot-com crash of 2000. But unemployment peaked 2003 and then started going lower. So it fell from near 6% to 5.5% in 2004, then to 5.1% in 2005. But it was trending lower as the economy started to grow. Here, we're not seeing the economy grow, and unemployment is expected to trend much, much higher from here. The Fed's doing everything in its power. That's why they're keeping interest rates high, because that's why they're not lowering them a lot quicker, is because the unemployment rate is still extremely low. Where are we, 3.7%? We're looking for it to go much higher, well above 4%. The Fed would probably like to see it at 4.5% or higher to maintain a downward trend in inflation. That's what they were hoping for, but they're not seeing it. That's why they're keeping rates stably high, even though they should be actually cutting based on where rates and inflation are right now. At the end of 2003, the Fed funds rate was just 1%. This is after a series of rate cuts starting 2001, and then I think they had one in 2002, maybe one in 2003, mid-2003. Okay, so we'll look at the Fed funds rate was 1% back then in 2004. We're over 5% today. Totally different market conditions. Inflation was just 1.7% in 2004. Today, it's over 3%. So you can't really compare markets and just, you'll see stats. And that's why I love really looking deep into the numbers, because you can interpret them however you want. You could say, well, last time this happened and the S&P went up 9 straight weeks, heading into a year, was 2004 and the market went up 9%. But the conditions were really different. Were totally different back then. And you're coming off of a terrible period, and now you're seeing like this bottoming out and explosion in growth, where 2004, later 2004, they started actually raising rates. It's totally different this time around. I didn't even get to deficits or anything. 34 trillion we are in deficits, which, again, you don't have to worry about de-dollarization or anything happening anytime soon, but it's, $1 trillion now we're paying just an interest expense on that debt. And now it's noticeable. Now it's a factor. It's a big factor. It could lead to cutting budgets in, 2024, 2025? Sequestration, which we saw in 2011. It's a big deal. I mean, how are we going to get our budgets in line? Because every single time that we've seen this, when you see those deficits go higher, it wasn't when unemployment was under 4%, right? Because that means you're getting more revenue in, more people working, right? And those tax receipts are coming in, the economy's supposed to be doing better. We've never seen this type of market. When unemployment is low and deficits are continuing to rise. Usually you're spending to grow the economy. So our government's all out of whack, and we know that. So totally different timelines and different factors. But again, it's nice to say, well, last time this happened, 2004, markets went up 9%. But let's put all this in perspective. And I want you to pay close attention, especially if you're bullish on equities for 2024, which almost every analyst that I saw on CBC of the past 2 weeks is. Everybody is bullish, including all but 3 of the 19 major investment firms who put out their S&P 500 forecast for 2024. So when I say 19 of the major investment firms, talking Goldman, Citi, Bank of America, Barclays, Evercore, Oppenheimer. But out of those 19, only 3, Morgan Stanley, Cantor, and JP Morgan, see the S&P 500 declining by more than 5% for 2024. And JP Morgan's actually forecasting a 12% decline in the S&P 500 for this year. Now, if you're bullish on equities, here's what you need to know. And that's fine if you are. I was very cautious on equities in 2013 outside of late October, early November, and the whole push with, again, just from a trading perspective, if you're looking, you were going to see a rally, a rip your face off rally that we really participated in. But for most of 2023, especially early on, I was bearish. We were still long a lot of positions of portfolio, just saying, hey, protect yourself a little bit, buy puts. It's just a very crazy market. And you're going to see right now why it's still one of the most dangerous markets I've seen in 30 years. Because it's not COVID, where I'm getting out of the market. Holy cow, I don't know what's going on. It's not the credit crisis. It's just going to blow up the whole financial system. Let me get out. Okay, this is a market where it's very expensive. A lot of things don't make sense. You didn't see earnings growth last year. And yet, you are forced to go into the market, or you're going to miss out and buy stocks at extremely high valuations. And then we finish the year with 9 straight weeks of increases. So here it is. Okay, what you need to know if you're bullish on equities. Or here's a better way to say this is, here's what's being priced into equities, since we all know the market is a forward-looking mechanism. meaning the S&P 500 is trading on what is expected to happen over the next 3 to 6 months. So here it is. Right now, we are trading at 20 times forward earnings. That is a huge, huge growth multiple. Considering we're going to see a meaningful slowdown in GDP in 2024, maybe below 1%. Also, we're trading significantly above the 10-year average of 17.5%. But if you look at those past 10 years, for most of those years, rates were very, 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 very low. We averaged probably 1% or less. I mean, we were 0, and then we went a little bit higher the past couple of years. But we averaged less than 1%. Now we're at 5%. So we're trading at an extremely, extremely high growth multiple. The market is assuming at least 6 rate cuts in 2024. That's what's projected. That's what the market is anticipating why we're trading at this level. It's assuming earnings are going to grow by 12%. Again, an economic environment that's expected to slow considerably from last year into this year. It's assuming sales will grow over 5%, which they grew, 2% over the past year? It's assuming that there's a absolute zero chance of a recession. And I could tell you, if GDP forecasts, again, the average is probably 1.4%. There's a few predicting lower than that. I think the highest might be 2.1. I think Goldman was in November. I think they lowered their estimates. But if you're telling me that you're going to see a full year of economic growth below 1%, you can't tell me one of those quarters are not going to be negative with the chance of another one being negative. We're pricing in a zero chance of a recession. Zero. Again, it's an election year. I know that there's never in history been a president who's been in office that got a second term. It's happened 4 times, I think, the past 100 since 1900, where the sitting president going in was in a recession. All of them got annihilated going into the election. So if we're in a recession, there's zero chance, unless the election's stolen or whatever you want to conspiracy, whatever you believe. But if we're in a recession, there's basically zero chance, unless something black swan, unusual craziness happens, that the Democrats will win. So they can do everything they can to spend to make sure the economy doesn't fall into recession. And that could be pressuring the Fed, which every president does, which Biden did for the first time a couple weeks ago, right before we had this big pivot with the Fed and Powell. Huge pivot. I mean, 2 weeks ago, he's like, no, we're not even close to lowering rates. And all of a sudden, nothing changed except the data got worse. The chances for a rate cut by May actually decreased after the data. And you had Powell come on and do that pivot and say, hey, we're probably going to start cutting. It's also assuming that there's going to be little geopolitical risks. You see what's happening, waterways, you see what's happening. Assuming that Russia, Ukraine is business as usual, no end in sight. Things fine, don't worry about it. Remember, Russia still controls a massive amount of the energy going to Europe. Europe wants to try to play hardball, but everybody's getting sick of funding the Ukraine here. They're losing pretty badly right now, which is not reported in the mainstream media. And it's also assuming that China won't invade Taiwan, which I believe is absolutely inevitable. It's going to happen. I say, Fred, that's crazy. No way that's not going to happen. But I can tell you, did you see the latest news? This is from yesterday with chip makers ASML. It's a Dutch-based company that makes high-tech microchips, or, more specific, one of the only companies in the world that makes extreme ultraviolet lithography systems, right? So these are essential for smartphones, EVs, AI. The U.S. pressured the Netherlands into cutting their exports of these chips into China. And China's pretty pissed. This follows the U.S. restricting NVIDIA to restrict the imports of its 2 chips. If you're not familiar with them, it's the A800 and the H800 chips. Okay, those are the 2 most powerful chips in the world, essential to building the most advanced AI systems. That's the one everyone's paying for. That's why they blow out the numbers all the time. And the U.S. saying, nope, we're restricting those chips going to China. So now China is being left out at one of the biggest technology revolutions in our lifetime, where AI is dominating everything. And we're taking, you're seeing our companies and our country grow tremendously when it comes to AI. And we're limiting growth in China, and they're being left behind. So basically painting China into a corner, right? Almost forcing them to invade Taiwan. Now, why would they do that? Because it gives them control over Taiwan Semiconductor. You're like, that's one company, Frank. What's the big deal? Well, Taiwan Semiconductor produces 90% of the most advanced chips in the world used to power every major technology trend on the planet. And we're basically limiting them as much as we can to get the biggest head start. What do you think China's going to do? What do you think we would do if we were restricted? What do you think if they restricted rare earth metals and all this stuff and made it so we cannot compete, where it's going to make China a million times stronger? In China, before the last 2-3 years, on its way to becoming one of the biggest economies in the world. And now things are absolutely horrible. You want to pull up a funny chart or a crazy chart, pull up 1 year performance of China stock market and U.S. stocks, S&P 500. And just look, I mean, the chart is going to go on the film here, is massive. I mean, you guys see how wide it is. It's incredible. How much China underperformed, how much the U.S. outperformed. But China's not going to sit on their hands during this. They can't afford it. Again, you're assuming that's not going to happen. This is going to be nothing, right? So these are all the things that you're assuming. So, again, all of this has to, if you're bullish, all these have to happen to support the current valuation of stocks. Now, if we do see some cracks, which could be expected, and again, this is to support the current valuations. I'm not talking about what's going to push stocks higher. Maybe that's the election. Again, you're going to... you're delaying the late penalties on student loans payments, which just kicked in again after 3 years of spending it. And you're going to have the current president, I don't care if you're Republican or Democrat, they're going to do everything they can to make sure the economy is as strong as possible and spend. And that's been the wild card. That's been the wild card in the markets for the past couple of years. Is this massive government spending going to so many different sectors that you couldn't really anticipate. And trillions of dollars that you still can't remove from the system, where we're still seeing inflation 50% up to higher than the normal rate, trying to get this money out of the system because it's trillions and trillions and trillions of dollars. What is it, 85% of all the dollars ever printed were printed in the past couple of years? I mean, it's insane how much money in the printing going on. They'll say if we see some cracks, and we see cracks in consumer spending, they start pulling back. And housing gets worse, which surprises not worse, right? We have a supply problem, but still it's different. I'm in Florida. My house has been on the market for 4 months. I've gotten one offer on it. And it's priced now. We lowered the price perfection. And it's on an island where home builders can't build, where the major home builders can't build, where they could build 40 house lots or 30 houses and stuff like that. And you could build individual homes and stuff, but there's not a lot of land there. It's a Amelia Island. It's not like this exclusive island. It's pretty big. But anyway, in the housing market, tails will say if we see cracks in regional banks, what's going to happen? Well, investors for the first time in 20 years, they have another option, a wonderful option. They can earn over 4% risk-free by putting their money in government bonds. So what does that mean for equities in 2024? I mean, when I look at the S&P 500 as a whole, right? Because that's what we look at, the market as a whole, where you can say the S&P 500 had a banner year. It's up 24% for the year. I think that's where it closed, 24%, I believe. Might have been 26% or whatever. But 75% of that was driven by the Magnificent Seven stocks. 75%. If you didn't have those, you probably didn't perform too well. You might have actually been down on the year. You had a nice ending to the year, but leading into, I would say, November, unless you have exposure to those 7 major technology companies, we all know them, you probably underperformed. So I'm not sure what the S&P 500 will end up. But what I do know is this is going to be the year of separation. We're not going to see all those stocks do great. We saw every one of them do great. Whether it's Apple, Tesla, Amazon, NVIDIA, Netflix, Google, Meta, right? All those stocks just up. But they're not all the same. I mean, Tesla just came out with results, which are pretty good, better than expected, but their margins are still horrible. Their margins are terrible. Their pricing power, right? They don't have that pricing power anymore. Seen a lot of competition into the market, even though a lot of them said, hey, we're going to slow it down a little bit, but it's very expensive to buy EVs. It is really expensive. And we're learning that this isn't a market that was going to be, everything was going EVs in 5 to 7 years. People don't want EVs. They don't like charging. There's a huge market for it. It's a big market for it. Maybe 10, 15, maybe 20% of the market, but that's probably it. I mean, I drive a lot. I drive a ton. Drive my kids to school and I'm driving to work. I'm going to open up an office near my house, but I drive, an hour and 15 minutes a day. When am I going to be charging it a lot? Charge it when I go home? That's fine. But when I drive down to Miami from Jacksonville, and I drive down to Palm Beach, I don't want to sit there and charge it. That's me. But you're going to see separation here. Because now you have, Tesla with the margins are really, really tough. You see the tough economy. A lot of people can't afford EVs. You're looking at Apple. Apple's getting hit right now. And it should have got hit a lot further. I mean, I've never seen anything in my life. No one has. But you're looking at Apple, which did not grow sales, and earnings grew less than 0.5% over the last 12 months, and you watch this company grow its valuation by $1 trillion. Holy shit, how's that possible? I mean, they have some major problems. One is with China and smartphones, right, and iPhones and iPhone sales. You see in the 15, you see reports out there, Barclays just downgraded them. iPad sales, Mac sales, and now that downgrade included, hey, we're probably going to see slower growth in services as more and more companies are fighting the App Store and found out that Google pays an absolute fortune to become the main browser on iPhones and stuff like that. But, this analyst actually sees their bread and butter, which is a high margin business, and those services revenue actually slowing down. Apple's trading at 30 times forward earnings, a massive growth market multiple where it's not growing. You have NVIDIA also trading at a huge growth multiple, and rightly so with the revenue that it generated and earnings and holy cow and buybacks and everything. But could they sustain that growth without China? I don't know. Because right now it's priced for perfection. However, when I look at some of the other names in that magnificence, Meta, Google, cheap, much cheaper than the other names I just mentioned, growing much faster than the overall market. Netflix has become the clear winner in streaming. It's going to start to see strong growth from advertising, probably going to generate a huge amount of cash flow. Again, it's just a matter of putting a commercial on. It's not like, the expenses for that's easily, and you talk about scalability, holy cow. And the hard part is getting it down. They said this is the year that you're going to see lots and lots of revenue being generated through advertising. And they have the audience, and they have people on that site forever. So it makes sense. Advertisers are going to be lined up out the door to freaking advertise for Netflix, and they're going to charge a fortune for it and get it. Kind of what Meta does. And also Google. So I don't see all seven doing well. I think Amazon's going to have a great year. It underperformed the markets. Now they got everything right in terms of retail, in terms of cloud. I think cloud growth's going to be huge next year for them. And Microsoft kicked their ass. Not really kicked their ass. They just took market share. They're still the industry leader, right? They just, Microsoft had a lot more growth, but you're going to see that growth slow. And I think for Microsoft, more than what you're going to see for Amazon, I think Amazon has a shot to take market share from Microsoft this year when it comes to cloud. But you're going to see a separation in stocks within different sectors. And that's why it's a stock picker's market. Also focus on sectors that didn't perform well in 2023. I don't know about oil. If you're expecting the economy to come down, you're going to be, you think you can pick and choose. And a lot of those names are trading at huge discounts and still seeing growth because they can make money at $70 a barrel, even $65, $60 a barrel, where that used to be the average cost to produce. Now it's, what is it, $30 for a lot of these guys? I think 55, 60 is offshore now, where that used to be 85 like 10 years ago, $90. But I think the better sector, one is healthcare, biotech in particular, and staples. And staples had a rough year, but look what they went through. They cut costs significantly. The supply chains are in much, much better shape. They're well positioned to benefit and see margins go a lot higher and easily beat estimates after seeing that slowdown, which is a tough year for them. The healthcare, again, in particular, I like biotech. I'm expecting a really big year, not in all biotech. But many names are still down 6% plus from their 2021 highs, including names that are generating revenue. So if you look, small caps past $500 million to maybe the mid cap level of $10 billion. There are unbelievable names. I mean, names that are generating revenue, generating cash flow, and have a great pipeline with drugs already FDA approved Now they're going into different markets. Their stock has gotten annihilated, so they lowered costs. They raised money already. I mean, there was so much leverage in this industry nobody talks about. Massive, massive, massive amount of leverage. Massive amount. All the warrants going on, all the deals behind the scenes and stuff like that. Holy cow. Dominated by just a few firms who all got annihilated. And some stocks that I thought were great, they were 100 and went to 60 and 50, are now at 20. I expected a lot of M&A activity in the sector, especially just seeing slower growth among the major healthcare companies. This is the way to capture growth. By buying companies with great pipelines that are dirt cheap right now, much, much cheaper than if you pay for them. You're going to be paying a 50% discount compared to if you wanted to buy them in 2020, 2021. In fact, that's where my next Curzio Venture Opportunity pick is coming out of. It's coming out tomorrow. But it's coming from that sector. The small cap biotech names down from $70 a share early this year to $25. Was generating revenue, great pipeline, great management team. It's a name I think could easily go to $75 to $100 by the end of this year. But all the negatives are priced in, and now they got everything right, and that's what you're looking for. Like, when you're a company and it's a shitty year, a shitty 18 months, what are you doing? You're restructuring. You're selling off weak divisions or factories, and you're trying to get your margins up, and you're cutting costs dramatically, and now you're putting yourself in a position because it's been so bad, and people think, okay, since it's bad the past 18 months, it's going to be bad forever. No. This is what corporations do. This is what management teams do. This is what they get paid to do. They're going to have ups and downs. It's how do you fix those problems? The Walmarts and the Amazons were able to fix them right away. They're in supply chain concerns and COVID. They're brilliant companies. But a lot of others, it takes a lot. Get rid of inventory, take care of supply chain, and just, again, have your company structure. We're now in position. We're much leaner. Now we're going to see earnings grow. Now if we can get sales back up, really focus, holy cow, you're going to see that stock absolutely surge. And that's what we are with biotech right now. But 2024 is going to be a stock picker's year. Focus on the companies with strong management teams. Companies have solid cash flow, which means they're probably buying back their stock and maybe increasing their dividend, which is huge. Buybacks are going to be a big thing in 2024. What GM did, it changed the whole perception of that company just by saying, hey, we're not focusing on EVs as much anymore. We're not going to spend $5 billion, $7 billion, $10 billion, $50 billion on this freaking trend that we thought was fantastic 3 years ago. We're going to take that money and buy back our stock. And the perception of that company has changed dramatically. And people are watching, just like they watched Meta. In 2022, that got annihilated. It was down 60%. And they said, hey, we cut costs by billions of dollars. What did all the major technology companies do? They started cutting costs. And they're still cutting costs. Some of them are still laying off employees and said, hey, that's the model everybody wants to see. Kind of like what Disney did. Let's get into streaming because Netflix carries a 50 times multiple and we're trading at 18 times multiple. But it didn't work out for them. But you're going to follow what's working on Wall Street and what the street wants to see. They want to see buybacks. You're going to see more major companies announce buybacks. That means that they're generating lots of cash flow. They got great balance sheets, and it puts them in a position, especially to grow their company further. Because if the economy does weaken, there's going to be a lot of companies that are going to fall sharply and maybe go bankrupt. And the companies with strong balance sheets are going to be there to pick up the pieces. It happens in every down cycle ever in existence. The big players always survive, and they buy up and pick up the pieces of all the other growth players that just mismanaged their cash balance. That's what you're going to see in 2024. Again, 1% GDP growth. It's going to be unlike what we saw for the past 13 years where growth dominated everything, outperformed everything. Now you have to be careful paying a high premium for growth, considering the slowdown we're going to see not just from the U.S. economy, but from the global economy. And what does that mean? It's going to force a lot of the Fortune 500 companies to cut back on CapEx spending. That is the biggest driver of growth, is how much companies are spending. How much are they going to yeah, they'll spend on AI and things like that they going to enhance productivity. But other things are going to cut back sharply on. If you're cutting back CapEx, that means you're not spending a lot and you're spending money. That means a lot of companies and that revenue is going to go lower and lower and lower. So you see companies cut CapEx, which you are seeing across a lot of the industries right now because they're fearful going forward where we have high interest rates, and even though they're supposed to be cut, we have an economy that's going to slow, inflation coming down, they don't have pricing power. These management teams are going to be super conservative, and they're not going to spend as much. You'll see the spending increase in AI and certain things, but a lot of the areas are going to be like, all right, let's cut back a little bit. That's going to hurt a lot of the growth companies. And I could tell you, if a growth company with a high multiple, they're going into earnings season and they're trading at 30 times, 27 times forward earnings, and they miss, and then they warn, these are names that are going to fall 15 to 20% in a day. In a day. It's going to punch you right in the face. So be careful, because you're buying growth companies at super growth multiples in a market that's supposed to slow down. And they say it's election year, and I get it. I mean, more spending from the government here and there. You might see that pushing the stocks, but I can't see the entire S&P 500 doing what it did, or all those Magnificent Seven companies doing what they did last year, especially some of them, because they're different. They're different companies. They're not all the same companies. Some of them are trading at 30 times earnings. Some of them are trading at 22 times earnings. Some of them are growing sales at 5, 7%, 10%, and earnings at 15%, 20%, and some of them aren't growing earnings and sales at all. But yet they're all going up, 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 up together. That's going to change this year. You're not going to see that. There's going to be interesting in 2024. I'm going to cover more of this tomorrow in detail, share some ideas in the Wall Street Unplugged Premium Podcast. If you want to learn more about that or subscribe to the podcast in the Dollar Stock Club portfolio for just $1, you can go to WSUpremium.com. That's WSUpremium.com. It's a podcast I do with Daniel. It's awesome. But we don't just talk about the macro part. We share lots of ideas and put one of those ideas every week into our Dollar Stock Club portfolio, and that we're going to tape tomorrow, which we tape every single Thursday. So, guys, that's it for me. Happy New Year. Thanks so much for listening. Love you guys. I'll see you tomorrow. Take care.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.